Is there any downside to harvesting capital gains in my kids' UTMA, assuming that I can keep them below the kiddie tax limit?
Oh, look at that. Taking advantage of the 0%.
I love it. So for those of you, oftentimes you hear us talk on the show about harvesting losses. It's this idea of if you have a position, a mutual fund, an ETF, a stock that has lost value, you can sell that position, capitalize on the loss that you've incurred in the position. You can go buy something that is not identical. You can't buy the same stock, you can't buy the same index. We can buy something similar to replace it. So that way you maintain the same investment exposure, but you capitalize on that loss, and when that asset class or that type of stock rebounds, you'll still be in the same investment posture. And then you can use those losses to offset current year capital gains or future year capital gains, or you can even use it to offset up to $3,000 of ordinary income in the current year. So it's an amazing strategy to use, harvesting losses. One thing that does not get as much press is harvesting gains. And there are a few different areas and scenarios where harvesting gains make sense. One of the ones we talk about all the time is when someone retires and their income drops and they've built up their 3 buckets to where they can manipulate their income to keep it below a certain dollar amount. Below a certain dollar threshold, you're actually in the 0% capital gains rate. So it might make sense to sell some of your gain positions up to the point where you would trigger the 15% capital gain, but no higher because it is a cliff, and you pay 0% on those capital gains. Well, it sounds like Ashley has figured out, man, okay, well, that's something that works on my tax return, but there might be a little bit of an opportunity for my kids where I could harvest gains inside of their UTMA account. And an UTMA account is just a custodial account where the child is the beneficiary in the account, but an adult of age serves as the custodian in the account. But the taxability is generally based on the child's taxability and the child's tax rates, where I can sell these positions and I can harvest these gains. And again, below certain thresholds, the kid pays 0% capital gains.
Yeah, what I was frantically trying to figure out is, I have these little cheat sheets. This is my 2025 quick tax reference.
Brand new, hot off the presses.
Brand new. And it's worth repeating where the 0% capital gains rates are. For single filers, it's under $48,000 of taxable income. For married filing jointly, it's $96,700. And head of household, it's $64,750. Trust and estates, it's $3,250. What I was frantically trying to figure out was where the
kiddie tax
threshold is, and we have broke my tax reference guide because it has no reference on there to that. But fortunately, you're connected to the wonderful World Wide Web and can give us some feedback on that.
So in 2024, any amount above $2,600 of income generated in a custodial account on a kid's behalf is taxed at the parent's rate. So my question, or the question that I would have for Ashley, the question I have for you on Ashley's behalf is, does it make sense? Like, should you be harvesting gains and trying to churn the account to reset basis? Or for most custodial accounts, unless they get really large, are they actually going to be generating that much income? I mean, in your experience, when you first opened up custodial accounts for your daughters, and as you were building those account ups, did you find that they were often having to pay tax on those accounts?
Well, now, I like index funds. So index funds are more tax efficient than mutual funds in a lot of ways, is because what I was finding is my basis was automatically going up over time just because of year-end distributions. But index funds, I do think that this is probably a very good strategy because a lot of times index funds, they just don't have a lot of turnover. And even the target retirement index funds, they just don't have so much turnover that it creates these big distributions. So you can have some pretty large capital gains start to build up in them. I don't hate this strategy as long as it's the hassle factor or it's back to that squeeze of the fruit has to be worth the trouble you're going to. But I think that this one potentially over the long term could be helpful. So do your research. But that 0% capital gains has always been a very effective thing. And this, by the way, we'll flip the script. This is for a young person. I think it's very important when you leave the workforce and if you're pre-Social Security, think about Roth conversions, think about 0% capital gains. When you're post-Social Security, You have to still think about those two things, but you also now take into account the taxability of Social Security. These are all the cool things of be very aware of what's going on with how taxes impact your investment as well as your lifestyle, because it is definitely an important thing. There's a reason so much time is spent on doing tax planning for our clients.
Love it.